YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks, and in this video we're going to talk about the top 5 mistakes that new traders make in the stock market and ways that you can avoid. Alright, but first, if this is your first time watching this video, please make sure you click that thumbs up button. It really helps the channel. Also, make sure that you subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. But yeah, so I want to make this video quick. If you've been trading for less than 2 years, then more than likely you are probably making these mistakes, or you may do it sometime in the near future. So by hearing these things, it's gonna resonate with you to be on the lookout for it. So one of the first mistakes that new traders make is by having little preparation, or just not having a lot of knowledge about a stock that they're trading in. They may not know things that they need to know about the business, or you may not even have a trading plan. One, you need to know what stock market that you're currently in. Okay, knowing what market that the stock you're looking at is in. Is it in a bearish market or is it in a bullish market? And one way that you can find that out is just by looking at different time intervals of that stock. Start with your 5-year mark. Is it in an uptrend? Is it going up or is it going down? Then you're gonna go to your 3-month, your 1 month, and then go to your day. Know the market that you're in. You know, whatever trade that you're looking at, know what market it is. Not knowing things about the company that you're investing in. So every time that you invest in a stock, essentially you are buying a piece of that company. So if you were just an investor and you went out and you bought or sold companies, or even if you did real estate, more than likely you're not gonna go and just buy a house or buy a business that you don't know anything about. And if you do that, you know, your chances of losing your return of investment are high. Okay, so the chances that you lose money when you don't have a lot of knowledge about what you're investing in, it just robs you of having a better grip on how you're gonna move in that industry or in your trade. We have a video that we did before, how to find value in a stock. Is the stock valuable? Is it overpriced? Is it undervalued? How's the stock doing? So those are things that you wanna know. P ratio. Click the link below and you'll have more information about finding the value of the stock. And lastly, not having plans for your trades. So whenever you are doing a trade, 90% of the work should be put into strategizing how you're going to do that trade. And there's 3 different things that go into making your plan for your trade. One, you're going to need to know what entry point you want to get in on that stock. So what price is it going to be beneficial for you to buy that stock? The stock might be $30 right now, but for your strategy, you may not want it until it goes down to maybe $28 or $29. So knowing things like what price you want to get the stock, that is important. Remember, we never want to do market buys. We never want to buy what the market is selling it, because you're going to get it at just any price, honey. They'll just give you anything. We want to make sure we get a good deal, right? You want to have good investments. So you're going to want to make sure you know your entry price. You want to set your limit orders and, you know, call it a day. Wipe your hands of that. Next, you need to know your exit point. When do you need to get out of the trade? You can't just stay in the trade forever. Well, you can be a long-term investor. That's another thing that goes into knowing what type of trader you are. Are you short-term, long-term? But whatever term you are, you need to be prepared and you need to have a plan. What is your exit strategy? And that goes into 2 different categories. You have your exit strategy. If the stock is going in your favor, when should you go ahead and take your profit? Because you don't want to get greedy. If you stay in too long, you already know the stock is going to go up and down. So, you know, you're on that ride up. When do you want to jump off? So you need to know what exit point is that if the stock market is going in your favor. And on the opposite, you need to know that if it's not going in your favor, what's the most amount of money that you're comfortable with losing on that trade before you get the hell out of there. Right? So that is your exit point, or your stop. What's your stop loss going to be on that? So there's 3 different things that you're going to want. When am I getting in? When am I getting out? Good or bad? Make sure that you plan and prepare for every single trade. All right, so that's the first mistake that you want to avoid. And ways that you can avoid that are, you know, obviously to plan. Write everything out. Know when you want to get in a trade and know when you would possibly want to get out. Also, you want to create your own comfortable profit points. So you might want to earn at least 10% on each trade, and you may want to lose no more than 2% on the trade. So that's going to be completely up to you. It depends on your portfolio size, and also we're going to talk a little bit more on that. I have something special for you in regards to all of that. So stay tuned, make sure you watch until the end. The second top mistake that new traders make is being too emotional, not having control and not being disciplined in your trades. Let's say you have a stock that you did buy for $50 and you're gonna have your stop price at 45. So once this stock goes below 45, you said that you need to get out of that stock. You've already looked at your points of resistance and support. I'll leave a link below to that video also, ways that you can find your points of support and resistance. Once you find your support, the lowest point that stock is gonna go at that time, and also you find your resistance, the highest point, okay, you've set your plan. So if it goes below, your support level that you've already done your planning, you've seen over time that this is your support level, you know that if it drops below this, it's probably going to continue dropping. Like, it's not a good sign. So if that stock goes below what you plan to stop, sometimes you might stay in there. You may be too emotional and you may say, you know what, I need to get this money. I need to get back the money that I lost. I don't want to sell it. I don't want to sell a loss. I do it. I've done it before. And you can't be emotional. You have to follow your plans, follow your strategy, okay? So think with your head, not with your heart, all right? It'll save you a lot of money. Let me fix my necklace. That can come with being greedy also. Greed, that's an emotion. Let's say that you have a stock and it is definitely going in your favor. You want to stay in there for as long as you can. You may hold on for it too long and end up losing everything. So with being too emotional, one question that you can ask yourself is, what is money to you? A lot of people will say money is security, money is power, money is a good life, it's safety. So if you have all of these feelings about money and you're applying that to how you trade stocks, every single time you lose, you're gonna think you're a loser, you're gonna think that you're not doing this, you're not doing well. Well, I'm here to tell you, you're going to lose, okay? You're going to fail with trading stocks. It's not possible to win 100% of the time. That's not gonna happen, it's not realistic. So with having control over your emotions, it's going to help you to see your strategies and your plans through to the end, because more than likely, your first thought was right. Follow your first mind. Don't you remember that when they said taking your test, don't go back and change your answers? You were probably right the first time, sis. Believe in yourself. One way that you can desensitize yourself to money and controlling your emotions in the stock market is decrease your trading size. Maybe instead of buying 10 or 20 shares of a stock, maybe just buy 5 and see what you do with that. That way you minimize your losses and you also minimize your anxiety. Trade in smaller amounts. Don't be too emotional. Control yourself. We're dealing with big bucks now. Put your big girl panties on. We're going on a ride. Okay, I don't know what I'm saying here, but if somebody walked in a room, they shouldn't be able to know if you were making $100 that day or losing $100. Keep it cute, have a seat. But just looking at that chart, don't be too emotional. The third top mistake that new traders make is not keeping records of their trades. So every single trade that you make, write it down. Write down the price that you bought it. Write down, and this honestly, you can even start writing this out in your strategies. Strategize what points you want to buy that stock. Then you want to already calculate what is the maximum amount or percentage that you want to lose on this trade. What are you comfortable with? You want to incorporate that, and that's going to be your stop loss. Once it goes under this, we're out of there. Jump ship, abandon ship. Anyways, yeah, you want to write that down. Write down how much you bought it for. Write down how many shares you bought. Actually, I have something for you. Okay, so I put together for you, I'm gonna have a link in the below. Go to the link below to download this, but I made an Excel sheet. So this is just a simple Excel sheet. So right here we have an Excel spreadsheet, and this is basically going to be your stock trading journal. It has everything that you need: the name or the ticker symbol, what stock is it that you're buying, what date did you buy it, how many shares did you buy, and at what price. And so automatically, once you put that in, it's going to calculate the total price for you. So you can start putting all that stuff in once you strategize, and you can already have all your buy limits, or your buy limits and everything like that. It's going to happen automatically. Then you want to put, after the fact, once your trade is done, what date did you sell it, and how many shares did you sell for what price. And for the fees, if you're using Robinhood, keep putting this at 0. If you leave it blank, then these next two aren't going to calculate. They calculate automatically, but it's going to give you your gains and your loss, or it's going to tell you how much you gained or lost in that and what percent you gained or lost. So if you have, the fact that you want to gain at least 10% on every trade, it'll let you know that. It'll also let you know if you lost, what percentage did you lose. Keep track of that. This is your journal. Now me, I use just a little booklet for my journal. I have my date that trade is going to happen. Usually I'll write all of this out, a little bit of information before I actually do the trade. So I'll write the reason why I got into this. So, prediction, you have your position. I'll just show you an example. This is how it looks. This is just my journal. It has a date, the reasons why I got into the trade, what's the price, and then also at the top and the bottom of the page, usually when you keep a journal and you keep tabs of what you're doing, it's gonna help you know what you're doing in the stock market, what plan you had, why didn't it fail, why were you successful, or possibly why you failed, and it's just gonna help you keep up with your trade. They say, show me a stock trader that keeps a journal and I'll show you a successful trader. So add to your success. Make sure you keep a journal. You can download this. I'll have this down below, or you can, use the same format and write it down. But for this, if you have a smartphone, most smartphones are able to use Excel, so you can just download it to your phone, keep it on you, and just type it in. That's that. The fourth mistake new traders and investors make is by having improper timing. So timing, especially with options in the stock market, is critical. So whatever prediction that you have, whatever strategy that you have, let's say you predict the stock to rise $2 or $3 within the next month. What if it does it not in that month? It might do it in 2 months. One way that you can increase the probability of your timing being correct is really using support and resistance points. It's critical. So for example, let's just look. We can go to the phone for this one. Let's just get a random stock. Okay, I'm just gonna use Apple. It's a very successful stock. So let's look at points of support and resistance here. Let's look right here. We're on Apple, and you see we are in an uptrend. This is at our one month mark. We are in an uptrend, but you see right here, we kind of had a little dip right here at the $381. Then we continued our increase. We dropped back down to around $385. So we saw before it didn't go below $381. It dropped close to that at $385, but if you followed that previous support, we knew it wasn't going to drop down. So honestly, $385 would be a good entry point. And then you have this increase to $393, which isn't that much. But you see here, when you were at this point, how long did it take for this to happen? From July 22nd to the 24th. So this is 2 days worth of trading. When you were on the 23rd or on the 22nd, sometime between that time, when you saw that it dropped below 381 or even the 385, then that would have been a good sign to jump the hell out, because as you see, it dropped to 370. And then on the opposite side of that, you see right here we have a point of resistance. So resistance meaning it's not going above that. We had 2 resistance points at 390, again at 393. You know that the stock right now is not going over that 390, really 390 point. Right here on this day, what is this, July 30th? Once you saw it hit, damn, oh my God. Yeah, okay, so if you were looking at it that day and you say, okay, I see some resistance points at 393. Once you saw it go to 390, that means that it broke through that resistance point. So she's on her way. And that's a way that you can use support and resistance. So critical on your timing. Timing is so important in stock, especially like I said with options, because of that expiration date that we talked about. If you don't do anything with that contract by that expiration date, it expires worthless and you lose your premium. Nobody wants to lose the premium. So timing, very critical. The last and the final mistake that a lot of new traders make is they don't calculate their risk to reward ratio, or triple R, RRR. That was a really good Rihanna album. That Rated R, really good album. Hey Rihanna. Anyways, number 5, yes, not calculating the risk to reward ratio. You know, a risk to reward ratio is essentially a ratio that depicts you wanting to minimize the amount of money that you lose. So what is your risk versus you wanting to make as much money as you possibly can, your reward. So how much are you willing to lose to get this reward? Okay, so it's going to be in a ratio. They have different ratios. Here's a couple of examples of the risk to reward ratio. So imagine that you would possibly be willing to lose $15 to gain 30, right? 15 to 30, what is that ratio? 1 to 2, right? So you have a 1 to 2 ratio that you're willing to risk 15 to gain 30. So if you're doing 3 trades, you need to get at least 1 out of the 2. That's where that 1 to 2 comes from. From 3 trades, you need to be profitable on at least 1. Because if you lost 2 15s, that's going to be 30, and you gain 130. That's just going to give you a break even, and you won't lose out on anything. But if you want to gain, then you're going to have to, or if you want to see profit, then you're going to have to do more or do better than, you know, just the break even amount. So you're gonna have to have a higher percentage of wins. But so I'm looking at this chart right here, and this is a positive risk reward ratio. So if you have a 1-to-1 ratio, it's like 50-50. Your win rate versus your loss rate is going to be 50-50. If you have a 1-to-2 ratio, that means that you would need to be profitable at least 33% of the time, so you can lose a little bit more. And as you get larger, RRRs are risk to reward ratio. Honestly, it's going to be easy for you to do. It's easier to make 1 win out of 20 losses, but also the likelihood that would be a huge profit. And so calculating your risk on reward ratio, that's essentially part of your screening process for that stock. How valuable would this investment be? Is this strategy worth my time? Is it worth my money? Is it worth me possibly losing my money to gain this? So honestly, it just depends on you. Your risk to return ratio, that's going to be completely on you. But I have here also that I'm going to have in a link below. I also have a diagram here for you. This is the stock trading risk return calculator, so it makes it easy for you. I have the steps here, and this is for a long position. And basically a long position means that you plan on that stock increasing in value or in price. So you're going to buy low to sell high. So you're going to want to put your entry price in. So what is the price that you want to buy this stock? What is the stop price, or the lowest amount that stock can go for you to say, I'm pulling out? Then you want to have your target price. What price are you expecting the stock to go to, or hoping? This would be, you know, your maximum exit point. So also support and resistance is going to help you gauge a good target price. Then you have your own percent risk. Your percent risk, you may not want to risk more than 2% or 5%. That's completely up to you, but you can put in whatever percent that you're willing to risk in your portfolio or account size. So how much money you have in your account to trade stocks. It's going to automatically tell you, based off your percent risk that you're willing to lose, it's going to give you a sensible number of shares that you can buy, how much it's going to cost you, and what you stand to lose if the stock price goes down to the stop price that you set for the number of your particular risk to reward ratio. That's completely up to you, but what I've seen some people say a good risk to reward ratio is something from 2.5, a ratio of 2.5 to 1 and above. This is going to really help you to calculate your risk versus your reward. And right here, it's going to give it to you in two ways. So right here in this first column in D, it's going to give it to you as a number, a numerical value. And then right next to it, they both have the same, not the same, but it has a similar formula. So it's going to give you the same amount, but in a ratio format. So the first column, this column is going to be in a dollar amount, or excuse me, a decimal amount. And then right next to it, to the right, it's going to be in a ratio format. So, you know, that's just another way to help you to be more successful with your trades. So remember those 5 things. I wanted to keep this short and cute, but that's basically it. So make sure you prepare, know what you're getting yourself into, what's the market, what is that stock market, or excuse me, what is that stock's PE ratio? Is it overvalued or is it undervalued? You want to know that. Find your points of support and resistance every single time. That is going to help you to gauge your timing of when you should get into and out of the stock. Keep records, write everything down, write your plans out, write out when you actually do get in the stock, when you buy it, when you sell it, for how much and how many you did. Know your gains, know your losses, and know your risk versus your reward. And that's really gonna help you in your stock market journey. So that's pretty much all I have for this video. Thank you guys so much for watching. Once again, if this is your first time watching my videos, if you found any value in this at all, please make sure that you click that thumbs up button. Also make sure that you're subscribed, and also click that notification bell so you get notified anytime I upload a new video for you guys, because you are going to want to hear what we have going on, especially once we start talking about options more, and eventually we're gonna move over to Forex eventually. So I appreciate you guys for rocking with me and growing with the channel. You know, we've really come a long way from 200 subscribers to going on 730. So we're close to 1,000. Thank you guys so much. I appreciate you. All right, and that's Foxtail Digital coming to you again. I'll catch you guys in the next video. All right.